So Federal Signal makes garbage trucks and street sweepers. We are basically talking about heavy, cyclical, municipal-dependent metal bending here.
Right, definitely not the kind of business model that, screams hyper-efficiency.
Exactly. I mean, it's a gritty industrial manufacturer.
Yeah.
Yet they just posted a quarter where every single dollar of reported net income magically translated into like $1.31 of actual tangible cash in the bank.
Which is just wild.
It really is. So today, in this deep dive, we are dissecting exactly how they are putting up these software-like cash conversion metrics. And more importantly, whether you as a retail investor should be treating this stock as a cyclical trade or maybe a long-term compounder.
Yeah, and the urgency here really cannot be overstated. When a company in this sector fundamentally breaks the historical mold of its peers,
right,
the market often takes time to appropriately reprice the asset. So we're cutting straight through the noise of their Q2 2026 earnings call today. We want to evaluate if the underlying structural changes at Federal Signal, that's ticker FSS, by the way, if they warrant a completely new valuation paradigm.
And look, your time is capital. So we are completely bypassing the basic accounting definitions today and just diving straight into the headline metrics.
Let's do it.
Because I'm looking at the top and bottom line beats, and the sheer volume is, honestly, it's jarring. Net sales hit $670 million for the quarter.
Wow.
Yeah. That is a 19% jump year over year. Adjusted EPS landed at $1.42, which is up 21%.
Okay, those are massive beats.
They really are. But the metric that frankly caught me off guard, adjusted EBITDA margin expanded by 60 basis points to hit 21.5%.
Yeah, and that margin expansion is really the linchpin of this entire quarter.
How so?
Well, pushing top-line revenue up 19% is impressive, sure. But historically, in heavy manufacturing, you often see margins actually compress during those rapid growth phases.
Because they're scrambling to keep up with demand.
Exactly. Companies overpay for raw materials, or they run excessive overtime, or they just accept lower margin volume just to keep the factory floor moving,
Right. That makes total sense.
So expanding by 60 basis points while absorbing 19% more volume, that indicates phenomenal factory floor discipline.
I look at that 60 basis point expansion kind of like a manufacturer tuning their assembly line calibration.
Yeah.
Like, they didn't just brute force more trucks out the door. They engineered a process where they waste slightly less steel, utilize slightly less labor per unit, and capture a bit more pricing power on every single chassis.
And dropping that pure operational leverage straight to the bottom line.
Exactly.
And that operational leverage is what generated the standout metric you mentioned at the top of the show, that $113 million in operating cash flow.
Right, the cash conversion rate.
Yeah, we need to focus heavily on that 131% cash conversion rate because, in the industrial sector, earnings beats can easily be manufactured on paper, right?
Oh, for sure.
Yeah.
Through aggressive revenue recognition or like capitalized inventory.
Right, exactly. But you cannot fake operating cash flow. It's actual cash in the bank.
See, I'm naturally skeptical when I see cash conversion that high. 131% rate usually raises a massive red flag for me.
Oh, yeah.
Yeah. My immediate thought is always, are they just artificially juicing the cash flow? Like liquidating a massive stockpile of inventory they built up last year.
Or stretching their payables.
Yes, exactly. Stiffing their suppliers just to keep cash on the books for the quarter's end.
It is a completely fair suspicion, but if you dig into the working capital mechanics they discussed on the call, this isn't a one-off accounting gimmick. The conversion rate is being driven by a structural maturity in how they manage their supply chain.
Okay, so it's systemic.
Right. That, combined with the natural depreciation schedule of their recent capital expenditures, they are efficiently collecting receivables and matching their inventory purchases really tightly to their billion-dollar backlog.
Wow, $1 billion backlog.
Yeah. It proves their pricing power is resulting in actual cash collection, not just, bloated accounts receivable.
Capital allocation always tells the true story of how real that cash is.
Always.
They didn't just sit on that $113 million. They aggressively paid down $97 million in debt during the quarter.
That's a huge chunk.
It is. That deleveraging maneuver leaves them with only $391 million in net debt.
Yeah.
And it opens up over $1 billion in availability under their credit facility.
Which is massive for flexibility.
Exactly. Generating cash today is great, but taking that cash to reload the balance sheet for future deployment, That is what builds a durable thesis for investors.
Which naturally forces us to examine how they actually generated that 19% revenue growth in the first place.
Right. Let's break down the engines driving this top line.
Yeah, because when an industrial company puts up those kinds of numbers in a single quarter, you really have to separate the organic demand from the acquired revenue.
Because organic is worth more.
Basically, yeah. The market values organic growth at a premium because it proves the core product is actively winning market share.
Got it. So let's start with the inorganic side then. The acquisitions of New Way and Mega.
Right.
Those contributed roughly $75 million to that $670 million in net sales. And New Way brings them deep into the refuse truck market, while Mega plugs them into mineral extraction support equipment, like heavy-duty water tanks and fuel trucks.
Yeah, and the revenue contribution is solid there, but the more critical narrative for investors is the integration velocity.
What do you mean by velocity here?
Well, when management acquired New Way late last year, they modeled $15 to $20 million in annual cost synergies by the end of 2028.
Okay.
But on this call, CEO Jennifer Sherman explicitly stated they are already tracking ahead of that schedule.
Okay, wait. I want to push back on the enthusiasm around quote-unquote synergies.
Fair enough.
Because we both know that, like, 9 times out of 10, corporate synergy targets are pure fiction.
Oh, absolutely. Just Excel spreadsheet magic.
Exactly. Designed to justify an overpriced acquisition.
Yeah.
So what exactly makes Federal Signal's integration process so credible that they are beating a 4-year timeline in a matter of months?
You have to look at the mechanical reality of supply chain consolidation in this specific industry.
Okay, walk me through it.
So Federal Signal is a massive buyer of commercial truck chassis, raw steel, and hydraulic components, right?
Right.
New Way, on its own, had a respectable purchasing footprint, sure, but nothing compared to the combined entity.
Ah, economies of scale.
Exactly. When Federal Signal integrates New Way, they immediately apply their master supply agreements to New Way's procurement. They don't have to wait years to recognize those savings.
That makes total sense. The moment the contracts are consolidated, the unit economics on every single garbage truck New Way builds instantly improves.
Right, so they go to a supplier and leverage their combined volume to dictate better terms.
Okay, so that handles the cost side. But
yeah.
Sherman's track record here is what really stands out to me.
Yeah, she's been aggressive.
She has. Achieving targeted synergies on the vast majority of 17 different acquisitions during her tenure. That suggests they have a highly formalized, repeatable integration playbook.
It's not just about buying revenue.
No, it's about buying inefficient revenue and aggressively optimizing it.
Precisely. And while the M&A engine accounted for $75 million, the CFO, Ian Hudson, noted that organic sales growth was still 6%.
Which represents what, about $31 million of the expansion?
Exactly. And that organic baseline was driven by a combination of broad-based demand across categories like vacuum trucks and safe digging equipment, alongside proactive price-cost management.
Which means their price increases to municipalities and contractors actually stuck. But the organic growth metric that fundamentally changes the valuation thesis of this company, it's the aftermarket business.
Oh, absolutely. The razor and blades model.
Yes, this is the industrial equivalent of the razor and blades model, and it is executing flawlessly. Aftermarket revenue grew 24% year over year.
The magnitude of that growth is impressive. But the resulting concentration is what retail investors should really prioritize here.
The percentage of total revenue.
Yeah. The aftermarket now comprises 25% of the Environmental Solutions Group, or ESG.
Wow.
And that is their largest operating division. So a full quarter of its revenue is now tied to predictable, recurring, high-margin parts and service.
Let's explore the mechanics of why this aftermarket moat is so formidable.
Let's do it.
When a municipality drops massive capital on, say, an Elgin street sweeper or a complex hydro-excavation truck, they're effectively held hostage by the need for uptime.
Right, because if a specialized hydraulic pump fails on a vacuum truck, the city can't just run to an auto parts store and buy a cheap third-party knockoff.
Exactly. They need the exact OEM part to maintain the warranty and ensure the vehicle gets back on the road immediately. Because trash still needs to be picked up. Streets need to be cleaned. So Federal Signal isn't just selling a piece of heavy equipment. They are locking the customer into a multi-decade ecosystem of replacement blades, hoses, pumps, and service hours.
And management is leaning into this aggressively with their build more parts strategy.
Build more parts. I like that. direct and to the point.
Yeah, they are utilizing capital expenditure in the second half of this year, specifically to expand their internal manufacturing capacity for replacement parts.
Vertical integration.
Exactly. Vertical integration here is vital because by manufacturing the parts internally rather than acting as a middleman for third-party component builders.
They capture the entire margin spread.
Exactly.
And they're also shrinking the geographic distance between their parts and the end user, which is super smart.
Yeah, proximity is leverage.
Totally.
Yeah.
Sherman highlighted that since 2019, they have added roughly 20 new service centers. In the municipal fleet world, if you can deliver the part and the service technician faster than a localized third-party mechanic,
You own that revenue stream for the life of the vehicle.
100%.
But the most compelling aspect of this strategy is how it applies to their recent acquisition.
Oh, you mean the arbitrage opportunity?
Yes. During the analyst Q&A, Sherman addressed the long-term goal of pushing aftermarket to 30% of total ESG revenue. And she pointed out a massive gap. Parts currently make up only about 11% of New Way's overall revenue.
That is a staggering disparity.
Right.
If the legacy Federal Signal businesses are running near 30% aftermarket penetration and New Way is just sitting there at 11%, I mean, the growth algorithm is sitting right there in plain sight.
It really is.
They simply have to map the Federal Signal aftermarket playbook, the service centers, the vertically integrated parts, the guaranteed uptime contracts directly onto the existing New Way customer base.
And it creates this internal growth lever that is entirely decoupled from the broader macroeconomic environment.
How so?
Well, whether a city decides to buy a brand new refuse truck next year or keep their old one running, Federal Signal captures the economics either way.
Oh, right, because older trucks need more parts.
Exactly. In fact, in a constrained municipal budget environment where new vehicle purchases are delayed, the reliance on aftermarket parts and service actually accelerates.
Which brings us perfectly into the great debate surrounding this stock. The fear of cyclicality.
Yeah, the legacy perception.
Right. The prevailing narrative on Wall Street has always treated companies tied to municipal budgets as highly vulnerable, like if tax receipts fall, capital expenditures freeze. But management spent a significant amount of time on this call dismantling that exact perception. They are actively pitching a de-risked revenue model.
Yeah, Sherman provided a specific metric that challenges that old metal bender stereotype. Currently, only 55% of their revenue is publicly funded.
Okay.
The company has aggressively diversified away from pure municipal reliance by building out product lines that serve industrial contractors, utility companies, and the broader commercial sector.
See, I hear that 55% figure, but I really want to scrutinize it.
Go for it.
Because even if 45% is commercial, being majority reliant on public funding still sounds risky to me in a tightening macro environment.
Yeah, I get that.
Like, how durable is that 55% public bucket if federal or state funding suddenly dries up?
Well, the durability comes from the extreme granularity of that public funding.
Granularity.
Yeah. It is not a monolithic municipal budget that's susceptible to a single political stroke. That 55% is fragmented across Canadian provinces, specialized law enforcement budgets, local trash collection fees, airport authorities, military contracts, European public sectors. It's everywhere.
Okay, so the fragmentation is key.
Exactly.
And they specifically noted that their absolute largest single source of public funding, U.S. water taxes, makes up less than 15% of total net sales.
Right. And water taxes are fundamentally different from general discretionary municipal funds.
Because they're tied to essential utility usage.
Yes, it is highly inelastic revenue. People don't stop using water during a recession.
That makes sense.
And to further address the municipal exposure risk, Sherman clarified during the Q&A that their Elgin street sweeper line is their only true pure play U.S. municipal business.
Really? Everything else has crossover.
So everything else has crossover commercial applications.
I guess street sweepers are the ultimate captive municipal product, right?
Yeah.
Because there's virtually no private commercial market for cleaning public roads.
Exactly.
But Sherman noted that the street sweeper business is only a mid to high single-digit percentage of overall net sales. So the one product line entirely dependent on local city budgets is less than 10% of the company.
And this structural de-risking completely explains the anomaly we saw in their order data this quarter.
The 18% jump.
Yeah. They grew total orders by 18% year over year to $637 million. And that's despite the fact that street sweeper orders specifically contracted in Q2.
That order book resilience is the proof of concept right there.
Oh.
Weakness in the pure municipal sweeper market was entirely absorbed and frankly overshadowed by organic demand for vacuum trucks, safe digging equipment, and dump truck bodies. They have insulated the top line from isolated sector shocks.
And that insulation is backed by that $1 billion total backlog we mentioned earlier.
Right.
Carrying $1 billion in guaranteed future work provides just unparalleled visibility for the management team.
It has to.
It allows them to optimize production schedules, lock in supply chain contracts at favorable rates, and confidently allocate capital without fearing like a sudden revenue cliff.
And that visibility clearly gave them the conviction to significantly raise their management guidance for the remainder of 2026.
Oh yeah, the revisions were huge.
They upwardly revised their full-year net sales expectation to a range of $2.58 billion to $2.67 billion. And more impressively, they bumped the adjusted EPS forecast to a range of $5.12 to $5.30 per share.
Look, upward revisions of this magnitude mid-year. That is a bold signal to the market.
Very bold.
They're essentially communicating that the operational efficiencies they realized in Q2 are sticky, and that the demand curve in their end markets remains highly robust despite any broader economic anxieties.
But, our objective here on the deep dive isn't just to parrot the bullish talking points. We have to pressure test this guidance.
Always. Let's do it.
A revenue range of $2.58 to $2.67 billion is nearly a $100 million spread.
Yeah.
In manufacturing, the delta between the low end and the high end of guidance usually hinges on supply chain execution. And when analysts pushed CFO Ian Hudson on the risks, he pointed directly at a legacy issue, the third-party Labrie refuse backlog.
Right, and that Labrie situation requires some critical context for the listener.
Walk us through it.
So in late 2025, Federal Signal made the strategic decision to exit the business of building third-party refuse trucks for the Labrie brand. They opted instead to focus entirely on their own internal refuse lines, heavily supported by that New Way acquisition.
Which is a smart strategic pivot to own your proprietary IP and margins, right?
Right.
But they're still on the hook for the orders they accepted before they killed the partnership.
Exactly. And Hudson disclosed that they still carry $44 million of this third-party refuse backlog.
Okay, so that's a big chunk of change.
It is. And the operational risk here is that Federal Signal does not completely control the supply chain for these specific third-party components. So if the parts required to build those final Labrie units are delayed, the revenue realization slips out of 2026.
Got it.
Hudson was incredibly candid about this. He said failure to deliver those units this year is the primary catalyst that would push them toward the bottom end, that $2.58 billion floor of their revenue guidance.
So we have a highly specific $45 million supply chain swing factor tied to a discontinued product line. That is a tangible risk investors can actively model. But beyond top-line risks, I really want to drill into the margin headwinds because, let's be real, the quarter wasn't universally flawless.
No, it wasn't.
The Safety and Security Systems Group, SSG, showed some friction.
Yeah, so the NSSG division handles public warning systems like tornado sirens and emergency vehicle signaling gear.
Okay.
They actually grew sales by 10%. However, their adjusted EBITDA margin contracted from 26.9% down to 25.1%.
A nearly 200 basis point drop in divisional margin while sales are growing. That usually indicates severe pricing pressure or input cost inflation. What drove the contraction there?
Hudson attributed it strictly to an unfavorable product mix.
Product mix.
Yeah. He specifically cited a higher concentration of large shipments on the systems side of the business.
Okay, what does that mean in plain English?
Basically, the large systems installations inherently carry a lower margin profile than just selling standalone products. It highlights the reality that top-line growth in this division does not flow to the bottom line linearly. It is highly dependent on what exactly is shipping in a given quarter.
Got it. We also have to address the rising corporate overhead. Corporate operating expenses ticked up to $17.8 million.
Right.
Hudson explicitly linked this to higher post-retirement expenses and increased medical costs.
And this is just the macroeconomic reality bleeding into the income statement,
Yeah, unavoidable.
No manufacturer, regardless of how efficient their factory floor is, can entirely escape the systemic inflation in healthcare and benefits.
But the critical takeaway for investors is how they manage that uncontrollable inflation.
Exactly.
Despite the medical cost headwinds and despite the SSG margin mix issue, the company still managed to expand their overall consolidated gross margin by 40 basis points, which drove that 60 basis point expansion in overall EBITDA we talked about earlier. It proves that their pricing elasticity and their factory floor efficiencies are currently strong enough to outrun baseline corporate inflation.
And crucially, they are absorbing those costs without sacrificing future capability.
Right.
They reaffirm their capital expenditure guidance at $45 million to $55 million for the year. And a significant portion of that is dedicated to expanding the aftermarket parts capacity we discussed earlier.
So they are playing aggressive offense with their capital rather than defensive cost cutting.
Exactly.
Which brings us to the ultimate verdict for this deep dive. We have analyzed the massive cash conversion, the accelerated M&A synergies, the structural de-risking of the municipal base, and the specific supply chain and margin headwinds.
We've covered a lot.
We have. So if you are a retail investor looking at FSS today, how do you categorize this earnings report? Bullish or bearish?
The signal here is unequivocally bullish.
Unequivocally.
Yes. Federal Signal is actively shedding the historical limitations of a cyclical industrial manufacturer. The financial profile we are analyzing today, the 131% cash conversion, rapid deleveraging, aggressive M&A integration, and a rapidly expanding recurring revenue aftermarket.
Yeah.
That is the profile of a diversified compounder.
Compounder is the highest tier of praise in capital allocation.
It really is.
It implies a company that can consistently reinvest its own cash flows at high rates of return, regardless of the macro environment.
And they have earned that label by pushing the aftermarket to 25% of ESG revenue and establishing a roadmap to reach 30%. They are building an internal shock absorber against economic downturns. They no longer require a booming municipal tax environment to drive earnings. They simply need the existing fleet of vehicles to keep operating and requiring service.
It is a masterclass in shifting from a pure transactional equipment seller to a lifecycle service provider.
Perfectly said.
But before we conclude, I want to introduce a subtle data point. It was buried at the very end of the analyst Q&A, and it points to where this lifecycle service model is heading next.
Oh, I know what you're going to say.
It completely shifts the long-term thesis.
You're tracking the integration of advanced analytics.
Exactly. When pressed on technology investments, CEO Jennifer Sherman revealed they have recently hired a new leader dedicated specifically to data analytics and artificial intelligence projects.
Yeah.
And Felix Boshin, the VP of Corporate Strategy, elaborated that they are actively exploring opportunities to use data analytics to drive organic revenue.
Now we have to translate what AI actually means in the context of heavy industrial vehicles.
Right. They aren't building ChatGPT for street sweepers.
No, exactly. This isn't about deploying generative language models. This is about industrial IoT and predictive maintenance.
The implications for the aftermarket flywheel there are massive.
Huge.
Imagine the unit economics when every Federal Signal vacuum truck or street sweeper is equipped with onboard telemetry, monitoring hydraulic pressure, component vibration, fluid degradation, all in real time. The vehicle's AI model predicts a critical pump failure 3 weeks before it actually happens.
And the monetization of that data is where the compounder thesis goes into absolute overdrive.
How so?
Because Federal Signal owns the localized service centers, right?
Yeah.
And they vertically integrate the parts manufacturing.
Right.
So the truck automatically communicates with the nearest center, reserves the proprietary OEM part, and prompts the municipal fleet manager to schedule the preventative maintenance.
Wow. So you transition from selling parts reactively when something breaks to selling guaranteed predictive uptime.
Exactly.
You eliminate the municipality's downtime risk entirely. And in exchange, Federal Signal captures a near 100% attachment rate on service and parts.
It locks out third-party mechanics completely.
Completely. If they are currently generating a 21.5% EBITDA margin and 131% cash conversion, utilizing a traditional reactive aftermarket model, the margin potential of a predictive software-enabled service network is staggering. It fundamentally re-rates the multiple the market should be willing to pay for this stock.
They cease to be just a metal bender and evolve into an industrial tech platform.
It is a long-term catalyst that retail investors need to monitor very closely as this new data analytics team executes.
The evolution is well underway, and Q2 2026 provided the definitive proof of concept that the foundation is incredibly robust.
Absolutely. So keep a close watch on the Labrie backlog resolution in the second half of the year, monitor the integration metrics on the New Way aftermarket expansion, and track how quickly they deploy that $113 million in cash flow. Thank you for joining us on this deep dive into Federal Signal. We'll see you next time.